Hey, MortgageSeth here. Just wanted to fly in and give you a 328,000 foot view of what's going on in the market. There's a lot of interest in what's happening with the housing market, interest rates, stock market, bond market. I know there's a lot of confusion out there, a lot of media hype, people trying to figure out exactly what this upcoming recession is going to mean for interest rates in the housing market, and I wanted to bring you my perspective on what it is. I have a great source of information. It's called MBS Highway, Barry Habib. He's been a trusted advisor in this space for years and years, and he gives daily updates on what's happening in the market, how to interpret the different indicators, technical values, and really helps me keep on top of what's going on with the mortgage market so that I can serve my clients better and advise them on what's going to happen with interest rates, where to lock, when to pay points, all these kinds of things that allow us to get into the best situations with outlook on the future, so that we're not paying additional fees or points if we think the rates are going to go down. Maybe there's an opportunity to refinance down the road at a lower rate and still get into the house that you want now for the lowest cost. So it's important that you work with someone that's seeing all these different indicators, and that we can help you so that you know exactly what the best choice is for the market. So let's take a look at some of the technical analysis. I won't overwhelm you, but I wanted to give you some insight on what I look at every day so that you could see what indicators I'm looking at. And for some of the things that I look at every day, what we really look at is the 10-year Treasury, because that's what's most closely tied to what's happening with interest rates. And if you look at the chart here, you can see what's been happening over the last few weeks is that this 10-year Treasury keeps dropping, and that's having a great effect on interest rates, that they're continuing to drop even more. Now, you might have heard some people talking about an inversion in the bonds. And what that means is that the 10-year Treasury yield, which is currently at 1.58, is being passed by the 2-year Treasury yield, and that's the inversion that they're talking about. And that really means that investors are taking a more short-term outlook on the economy and where it's going, that investors would rather put their money in a 2-year bond rather than a 10-year bond, and that's why we're seeing the yields come up on the 2-year. It's really interesting, really historical. This doesn't happen often. So when this happens, it's really a sign that the recession is getting into full swing, coming soon. And it's a time to look at what that's going to do for the housing market. So you can see the stock market today was down significantly, which also has a positive impact on bonds typically. And this number, just if you're curious, this is the mortgage-backed security number, and it shows us that has improved by about 22 basis points for today. So even though the stock market is taking a hit today, that means it's good news for mortgage rates and for bonds in general, and that we can expect to see rates continue to drop as we go into this next period. So what that really means for housing, though, I wanted to kind of touch on that really quick, is that during the recession, we'll typically see unemployment rates go up, right? That's what happens during a recession. So just for example, if we look at a 4% unemployment rate right now, if that goes up to 8%, then that would mean that there's about 3 million more people that are unemployed. And of course, it's unfortunate. Those people aren't going to be shopping for homes. They're going to have other priorities, of course. And the effect on the housing market, you would think, is that's a negative, right? When unemployment rate goes up, you would think that there's fewer buyers in the market, less demand, and that the demand for housing would go down. But let's take into consideration the other things that happen during these periods of recession, is that the interest rates are going to continue to go down. I think we're heading for some historic lows. I use a service that I showed you called MBS Highway, and that's Barry Habib. He keeps us updated every day with updates on what's going on in the markets and how to interpret all these different indicators and all the reports that come out. So according to all of this, the affordability index is what we need to be paying attention to. So even as wages steady out, unemployment numbers go up, that also means that when the interest rates go down, since people still have jobs, that there's going to be more people that can afford to buy houses. So even though there's millions that are newly unemployed that aren't in the market for buying houses at the moment, that will mean that since the interest rates are down, there's more people that can afford those new mortgage payments with the lower interest rates. So we're going to see a shift from the renting market, where the rents keep going up, up, and up. As interest rates go down, we're getting closer to the point where people are making that decision. I'd rather not be renting these high rents. I see interest rates down at a low point, and that's making the affordability of housing much higher for people that are still employed during this recession. So kind of have to look at the big picture. It's good to work with somebody that has all this in mind, has access to all this information, and we can really help advise you on what the best decision is. And if you have any questions, feel free to get in touch with me or my team, MortgageSeth.com, and be happy to help you navigate through all these tumultuous times that are coming up. Don't believe what you see in the media. The bad news is what they always want to bring to the forefront. Remember, California is a very different market. The Bay Area specifically, even the greater Bay Area down into the valley where people are moving, we're going to see housing costs steady out a little bit, but the affordability index is what you need to keep an eye on, and that's going to keep demand high and keep the appreciation going up over the long term. So let me know how I can help. Let me know what questions you have, and I'd love to get in touch with you, and good luck to you. Take care. Bye-bye.